Hello, this is Kirk Lynch, Associate Professor of Accounting at Sandhills Community College. In today's lecture, we'll be discussing assets. At this time, you should already know what is and what is not an asset. We will be discussing in greater detail some of the concepts that we've covered in the past, specifically the cost of assets and what goes into determining the cost we record an asset at once it is entered into the journal, and how we determine or calculate the amount of depreciation we record for that asset in an accounting period. The total cost recorded in the acquisition of an asset includes the cost to get the asset into place and working in addition to the actual cost to buy the asset. These expenses are included in the total cost of recording the value of the asset and therefore become part of the amount depreciated over the life of the asset. Your textbook lists a number of possible costs associated with acquiring fixed assets and therefore determining the cost to record the assets and the basis for depreciation. Here we see possible costs for various capital assets that would be included in the cost of obtaining and preparing that asset for use and increase the cost to record that asset on the accounting books. The important thing to note is the actual cost recorded in the ledger for assets would include these types of costs to determine the total cost recorded and depreciated for that asset. By now, we should be familiar with the classified balance sheet and the separation of current assets and capital assets, also known as property, plant, and equipment, or fixed assets. All capital assets are depreciated over time. Part of the expense of an asset is written off each year, with the exception of land. Capital assets are those assets expected to last more than 1 year. In earlier lectures, we discussed adjusting entries when we learned about depreciation. At that time, we were always given the depreciation amount to adjust. This lecture discusses how to determine fixed asset cost and how to depreciate that cost using a variety of acceptable methods. There are several valid ways to calculate depreciation. We will learn how to calculate them 3 of these ways. Here we see those 3 methods listed, as well as MAKERS, which is the Modified Accelerated Cost Recovery System, which is the IRS specified method for calculating depreciation for tax purposes. We will learn how to depreciate assets using straight line, units of production, and the double declining balance method, which is also known as an accelerated depreciation method. There are some basic information needed in order to calculate the amount of depreciation that will be entered as an adjusting entry at the end of the accounting period. That information includes, number 1, the cost of the asset, number 2, the estimated value of the asset at the end of its useful life, also known as the residual value, and number 3, the term of its useful life, or the amount of usage. Here we see the formula for straight line depreciation method. It's the most common form of depreciation. It's easy to calculate, and it provides a uniform expense over each year that we provide depreciation. We calculate straight line depreciation using the following 2 formulas. Number 1, calculate the amount of depreciation that we'll be expensing over the life of the asset by taking the cost and subtracting out the residual value. This provides us with something termed the depreciable amount. We then take that depreciable amount and divide it by the useful life of the asset in number of years, and that provides us with the amount of depreciation that we write off in an accounting period. For example, we see here that we assume we purchase a new machine to bind and produce sales proposals. The cost of the machine, including installation, training, shipping, and installing a separate electrical outlet for the machine, totals up to be $25,000. We are also told that the residual value of the machine after 5 years of useful life is estimated to be $5,000. So using our formulas that we had on the previous slide, the first thing we need to do is calculate the depreciable amount, and we take that by taking the cost and subtracting out a residual value, in our case 25,000 minus 5,000, and we find that our depreciable amount is $20,000. Step 2 is to then take that depreciable amount and divide it by the useful life of the asset, which was estimated in our case to be 5 years. So 20,000 divided by 5 years tells us that each year we can write off $4,000 of depreciation for this particular machine. Now, the second method that we're going to talk about is the units of production method. The units of production method of calculating depreciation is useful if the asset usage varies and it's measurable, such as number of machine hours that it's used or the number of units that it produces while it's being used. And if we have that information and it's that type of an asset, then we can use the units of production method. And we see that there's a 3-step process that we need to go through in order to calculate our depreciation for that. And the first one is just like the straight line depreciation method. We have to calculate our depreciable amount, and we'll be given a cost and a residual value, and our cost minus our residual value will give us our depreciable amount. Now, step 2 is somewhat different. We take that depreciable amount and we divide it by an estimate that we have for the life of the usage. In other words, we may be told that our machine will be used, will have an effective life of 25,000 machine hours. And so we take the depreciable amount and we divide it by the useful life of usage, and we get a number that is our depreciation per unit of usage. And then our third step to calculate our depreciation in any accounting period is to take that number we've just calculated, the depreciation amount per unit of usage, and multiply it by the actual usage that we had in that particular accounting period, and that tells us the amount of depreciation that we can write off in that particular accounting period. Here we see a similar example that we had before. We've modified it slightly to show now that instead of 5 years worth of usage, this time our machine is going to be used to make 50,000 bindings. And so if we follow the 3 steps that we've discussed in the previous slide, the first one is to calculate our depreciable amount, which turns out to be the same as we had in the straight line method, $20,000. Our cost is still $25,000. The residual value is still $5,000. Our depreciable amount is $20,000. And now we take that depreciable amount and we divide it by the amount of usage that this machine is going to provide to us. In our case, 50,000 bindings. So 20,000 divided by 50,000 shows us that we can write off depreciation of 40 cents for every proposal that we end up binding in this accounting period. And then we're also told that in this particular accounting period that we bound 11,000 proposals. And so we simply take the actual number of proposals that were bound times our per proposal binding rate, which is 40 cents, and we come up with the amount of depreciation for this accounting period to be $4,400. And so we would then enter our journal entry, depreciation expense on equipment, $4,400, and then credit accumulated depreciation on our equipment for $4,400. Now, the third method of accounting is the double declining balance method. And it's also known as an accelerated method. An accelerated method allows us to take a larger expense in earlier years of a machine in order to reduce our tax liability, because the larger of an expense will reduce our net income, and the lower the net income, the lower the tax liability. So accelerated depreciation methods are attractive because they have tax consequences that promote the investment in capital assets. Now, we need several steps in order to calculate the double declining balance method. And the first one is to determine the straight line rate. And what we mean by that is, if we were going to depreciate this piece of equipment using the straight line method, what percentage of the total depreciable amount would we write off in each year? And for our previous example, we had a 5-year asset, and so 20% of that asset is written off in each year of the depreciable amount. So step 1 is determine the straight line rate, and we do that by taking the number 1 and dividing it by the number of years of useful life, which in our case was 5, so we would come up with 1/5, and 1/5 converts to a decimal of, a decimal of 20%. So 20% would be written off each year. Step 2 is to take that straight line rate and double it. All right. So if it was 20% and we doubled it, it would become 40%. And so that's the amount that, using the double declining balance method, we get to write off in an accounting period, 40%. Step 3 is determine the book value of the asset. And in year 1, that's very easy to do because there's no accumulated depreciation. If you'll recall from our discussion several lectures ago, the book value is the cost of whatever asset it is, less the accumulated depreciation. And in year 1, that is the cost. We have no accumulated depreciation. So step 3, determine the book value of the asset for the particular point in time that we're talking about. Step 4 is to multiply the book value by double the straight line rate, which we determined in our discussion that it was 40%, but it could vary depending on the useful life of the asset under the straight line method, and we'll look at different examples of that as we work some exercises out of our textbook. The result will provide you with the amount of depreciation in your adjusting entry. So after we take the book value, multiply it by double the straight line rate, we'll come up with a number, and that's how much depreciation we get to write off in that particular accounting period. Notice that we do not take residual value into account at this particular point in time. The book value is all that we calculate, or all we care about, rather. Step 5 is to then calculate the new book value, which is the old book value less the depreciation that we've just recorded. And so we have a new book value, and then we repeat the process that we started with in this particular example. Just a note, a heads up, that as we go later in the life of an asset, we have to check to see what our book value is, because we can never take our book value to be less than the residual value that we've stated in our particular example. So once the book value reaches the residual value, we've reached the end of the amount of depreciation that we're allowed to take on that particular asset. Here we go back to our example. Same information as we had before. We bought a machine, cost is $25,000, residual value is $5,000, useful life is 5 years, and we're going to recalculate depreciation on this using the double declining balance method. One thing to note here is that the residual value is $5,000, which in our initial calculations does not come into play, but as we get towards the end of our accounting life of our asset, remember, our book value can never go below, in our case here, $5,000. So first step is to calculate the straight line rate, and in our case it was the same as the example we gave earlier. 20% is the straight line rate, and we got that by taking 1 and dividing by the useful life, which in our case was 5 years, and we got 1/5, and we convert that to a decimal point, which is 0.2, or 20%. Step 2 is twice the straight line rate. The 20% becomes 40%. And step 3 is to calculate the current book value, which in our case is the cost of the asset. And so in year 1, we take $25,000, our book value at this time, multiply it by 40%, and we come up with $10,000. And this is the amount of depreciation that we take in year 1 for this particular asset. So we would then debit accumulated depreciation expense for $10,000 and credit accumulated depreciation for our equipment for $10,000. And we compare this to what we got in the straight line rate, which was $4,000. It's a much larger write-off. The depreciation expense reduces our net income by an additional $6,000 over what the straight line rate would have provided. And so when we reduce net income by $6,000, it has substantial tax consequences, which is the reason the declining balance method is an attractive option for some companies. The next step was to then calculate the new book value, and our cost was $25,000, and we've just written off $10,000 of accumulated depreciation, and that leaves us with a book value of $15,000. So if we move on to year 2, we follow the process again. We already know what our straight line and twice the straight line rate is. That doesn't change. We still have, we take our new book value, which is $15,000. We multiply it by 40%, which is our twice the straight line rate, and we find out that our depreciation in year 2 is $6,000. And so if we take our, calculate our new book value, our cost minus accumulated depreciation, and at this point our accumulated depreciation is $10,000 plus $6,000, or $16,000 in total, we find that the book value going into year 3 is $9,000. And so in year 3, our depreciation, if we would take 9,000 times 40%, we would come up with $3,600. And so we follow that process. Into year 4, our book value is now $5,400. Remember, we can never depreciate our asset below its residual value, which was stated as $5,000. So in year 4, our depreciation is limited to $400, which will take us from a book value of $5,400 to a book value of $5,000, and that's where we equal our residual value. And we have already now used all the depreciation expense that we get on this asset. So in year 5, we still have a useful asset according to our useful life, but we no longer have any depreciation expense that we can write off in this final year. So we can see that years 1 and 2, we write off more depreciation expense than we did in the straight line method, but by year 3, our depreciation is less than the straight line amount, and in year 4, substantially less, and in year 5, we don't have any depreciation expense at all. So the upside of the double declining balance method is a larger tax write-off up front, but at the end of the life of the asset, we have no expenses to write down. So in summary, the straight line method of depreciation is the most widely used and the easiest to calculate. The units of production is useful for machinery that is used different amounts in different years, and we can easily calculate the amount of usage that we have on that particular asset. And the double declining balance is an accelerated method of depreciation, and it allows for larger expenses of depreciation in earlier years. All these calculations that we have discussed to this point have been based on a full year's worth of depreciation, and so if we bought an asset mid-year, we would have some additional adjustments to be made here. And if you take a look at the exercise that we have available, the sample problem that we're going to be working, we'll address this partial year depreciation phenomenon when we calculate straight line units of production and double declining balance methods sometime mid-year for the purchase of an asset. I hope this has been helpful to you, and we look forward to talking to you next time.